Want to get into trading where you can make thousands of dollars from the comfort of your own home, but don't know where to start? Just do this. Hey everybody, welcome to Make Money from Home. Today we're going to take a look at exclusive day trading strategies for beginners that you can apply and use yourself to become an expert at trading. Make sure to stay to the end for unrevealed tips and tricks. It's going to be a good one, so let's dive right in. Day trading is the act of buying and selling a financial instrument within the same day or even multiple times over the course of a day. Taking advantage of small price moves can be a lucrative game if it's played correctly, of course. But it can be a dangerous game for newbies or anyone who doesn't adhere to a well-thought-out strategy. Not all brokers are suited for the high volume of trades made by day traders, however. But some brokers are designed with the day trader in mind. Today, we'll take a look at some of the general day trading principles and then move on to deciding when to buy and sell, common day trading strategies, basic charts and patterns, and how to limit losses. This information will really benefit you if you're thinking of getting into the game. So smash the subscribe button and let's get started with this legit, easy, and professional list. Before we get started, it's important you understand these 2 points I'm about to mention. Day trading is only profitable when traders take it seriously and do their research. Day trading is a job, not a hobby. Treat it as such. Be diligent, focus, objective, and keep emotions out of it. Now that we've had a quick recap, let's look and provide some basic tips and know-how on how to become a successful day trader. 1. Knowledge is power. In addition to knowledge of basic trading procedures, day traders need to keep up on the latest stock market news and events that affect stocks, the Fed's interest rate plans, the economic outlook, etc. So do your homework. Make a wish list of stocks you'd like to trade and keep yourself informed about the selected companies and general markets. Scan business news and visit reliable financial websites. Doing this will benefit you massively, trust me. 2. Set aside funds. Assess how much capital you're willing to risk on each trade. Many successful day traders risk less than 1 or 2% of their account per trade. So if you have a $40,000 trading account and are willing to risk 0.5% of your capital on each trade, your maximum loss per trade is $200, 0.5% times 40,000. Set aside a surplus amount of funds you can trade with and you're prepared to lose. Remember, it may or may not happen. It's always important to take that into consideration. 3. Set aside your time too. Day trading requires your time. That's why it's called day trading. You'll need to give up most of your day, in fact. Don't consider it if you have limited time to spare. The process requires a trader to track the markets and spot opportunities, which can arise at any time during the trading hours. Moving quickly is key. It might be annoying having to give up time, but it'll be worth it in the long run. 4. Start small. As a beginner, focus on a maximum of 1 or 2 stocks during a session. Trading and finding opportunities is easier with just a few stocks. Recently, it has become increasingly common to be able to trade fractional shares, so you can specify specific smaller dollar amounts you wish to invest. That means if Apple shares are trading at $250 and you only want to buy $50 worth, many brokers will now let you purchase 1/5 of a share. How crazy is that? 5. Avoid penny stocks. You're probably looking for deals and low prices, but stay away from penny stocks. These stocks often aren't liquid, and chances of hitting a jackpot are often bleak. Many stocks trading under $5 a share become delisted from major stock exchanges and are only tradable over-the-counter, OTC. Unless you see a real opportunity and have done your research, stay clear of these. 6. Time those trades. Many orders placed by investors and traders begin to execute as soon as the markets open in the morning, which contributes to price volatility. A seasoned player may be able to recognize patterns and pick appropriately to make profits. But for newbies, it may be better just to read the market without making any moves for the first 15 or 20 minutes. The middle hours are usually less volatile, and then the movement begins to pick up again toward the closing bell. Though the rush hours offer opportunities, it's safer for beginners to avoid them at first. Make sure you are taking notes because the list is about to get better. You don't want to miss this. Disclaimer. Quickly, if you're enjoying the video, make sure to subscribe, leave a like, and let us know what tips and videos you want to see next. We would love to hear. 7. Cut losses with limit orders. Decide what type of orders you'll use to enter and exit trades. Will you use market orders or limit orders? When you place a market order, it's executed at the best price available at the time, therefore, no price guarantee. A limit order, meanwhile, guarantees the price but not the execution. Limit orders help you trade with more precision, wherein you set the price, which is not unrealistic but executable for buying as well as selling. More sophisticated and experienced day traders may employ the use of option strategies to hedge their positions as well. What do you think about this? 8. Be realistic about profits. A strategy doesn't need to win all the time to be profitable. Many traders only win 50 to 60% of their trades. However, they make more on their winners than they lose on their losers. Make sure the risk on each trade is limited to a specific percentage of the account and that the entry and exit methods are clearly defined and written down. 9. Stay cool. There are times when the stock markets test your nerves. As a day trader, you need to learn to keep greed, hope, and fear at bay. Decisions should be governed by logic and not emotion. If you can do this, you're well on your way to making a good income from trading. 10. Stick to the plan. Successful traders have to move fast, but they don't have to think fast. Why? Because they've developed a trading strategy in advance, along with the discipline to stick to that strategy. It's important to follow your formula closely rather than trying to chase profits. Don't let your emotions get the best of you and abandon your strategy. There's a mantra among day traders: plan your trade and trade your plan. Before we go into some of the ins and outs of day trading, let's look at some of the reasons why day trading can be so difficult. So you might be asking, what makes day trading difficult? This is why. Day trading takes a lot of practice and know-how, and there are several factors that can make the process challenging. First, know that you're going to go up against professionals whose careers revolve around trading. These people have access to the best technology and connections in the industry, so even if they fail, they're set up to succeed in the end. If you jump on the bandwagon, it means more profits for them, and Uncle Sam will also want a cut of your profits, no matter how slim. Remember that you'll have to pay taxes on any short-term gains or any investments you hold for 1 year or less at the marginal rate. One caveat is that your losses will offset any gains. As an individual investor, you may be prone to emotional and psychological biases. Professional traders are usually able to cut these out of their trading strategies, but when it's your own capital involved, it tends to be a different story. Deciding what and when to buy. Day traders try to make money by exploiting minute price movements in individual assets, stocks, currencies, futures, and options, and more, usually leveraging large amount of capital to do so. In deciding what to focus on in a stock, say, a typical day trader looks for 3 things. 1. Liquidity. This allows you to enter and exit a stock at a good price. For instance, tight spreads, or the difference between the bid and the ask price of a stock, and low slippage, or the difference between the expected price of a trade and the actual price. 2. Volatility. This is simply a measure of the expected daily price range, the range in which a day trader operates. More volatility means greater profit or loss. 3. Trading. The volume is a measure of how many times a stock is bought and sold in a given time period, most commonly known as the average daily trading volume. A high degree of volume indicates a lot of interest in a stock. An increase in a stock's volume is often a harbinger of a price jump, either up or down. Once you know what kind of stocks or other assets you're looking for, you need to learn how to identify entry points. That is, at what precise moment you're going to invest. Here's an exclusive list of tools that can help you do this. Real-time news services. News moves stocks, so it's important to subscribe to services that tell you when potentially market-moving news comes out. ECN Level 2 Quotes. ECNs, or Electronic Communication Networks, are computer-based systems that display the best available bid and ask quotes from multiple market participants and then automatically match and execute orders. Level 2 is a subscription-based service that provides real-time access to the NASDAQ order book composed of price quotes from market makers registering every NASDAQ-listed and OTC bulletin board security. Together, they can give you a sense of orders being executed in real time. Intraday candlestick charts. Candlesticks provide a raw analysis of price action, which is important in trading to make the most money. Finally, let's talk about deciding when to sell, which is a crucial stage and element to trading overall. There are multiple ways to exit a winning position, including trailing stops and profit targets. Profit targets are the most common exit method, taking a profit at a predetermined level. Some common price target strategies are Scalping. Scalping is one of the most popular strategies. It involves selling almost immediately after a trade becomes profitable. The price target is whatever figure that translates into "you've made money on this deal." Do you understand? Let us know in the comments. Fading. Fading involves shorting stocks after a rapid upwards movement. This is based on the assumption that 1. They are overbought, 2. Early buyers are ready to begin taking profits, and 3. Existing buyers may be scared out. Although risky, this strategy can be extremely rewarding. Here, the price target is when buyers begin stepping in again. Finally, daily pivots. This strategy involves profiting from a stock's daily volatility. This is done by attempting to buy at the low of the day and sell at the high of the day. Here, the price target is simply the next sign of a reversal. Which method is your favorite? In most cases, you'll want to exit an asset when there is decreased interest in the stock as indicated by the Level 2 ECN and volume. The profit target should also allow for more profit to be made on winning trades than is lost on losing trades. If your stop loss is 5 cents away from your entry price, your profit target should be more than 5 cents away. Just like your entry point, define exactly how you will exit your trades before entering them. The exit criteria must be specific enough to be repeatable and testable. Once you apply all of these steps and tips, you'll be the master of trading. So if you enjoyed today's video and would like to see more, be sure to subscribe and turn on notifications so you don't miss more videos of how to make money working from home and much, much more. Check out this video, and I'll see you soon. Take care.